Welcome to Within the Frame, where we bring the most pressing issues across the globe into focus. I'm Kim Mok-yeon. The Bank of Korea has kept its benchmark interest rate unchanged at 2.5%, extending its pause for an eighth straight meeting. But despite the hold, today's meeting under new Governor Shin Hyun-song delivered a noticeably more hawkish message. The central bank sharply raised both its growth and inflation forecasts, while the updated dot plot showed most board members now expecting higher rates ahead. And with inflationary pressures rising from the Middle East, the won remaining weak above 1,500 per dollar, and Korea's economy continuing to outperform on strong AI and semiconductor exports, markets are increasingly viewing today's decision as a possible turning point toward a new rate hike cycle. For a deeper analysis on this, we connect to Shin Se-don, professor of business economics at Sookmyung Women's University. Big welcome, Professor.
My pleasure.
And also joining us is Kim Yong-jin, professor at Seogang Business School. Great to see you again, Professor.
Good evening. Pleasure to be here.
Good to see you. Now, let's start the discussion first with Professor Shin. So like I've said, the BOK kept rates unchanged today, but Governor Shin also made clear that rate hikes may be needed at an appropriate time. How would you interpret the overall message from the meeting?
Well, we know that there's a leadership change beginning this meeting, and also one of the key Dovish member of MPB has retired. So it is complete kind of a restructuring of the MPB, and that is the most important thing. And I think the Bank of Korea wants to convey the idea that the time has come eventually to raise the rate, because PPI recorded 6.9% in April. That is highest since 2022. And also the price for living necessities rose 3.06%, which is highest in almost 2 years. So far, stable prices and stable inflation has been the main theme of not changing the rate. But for the last couple of months, the situation changes, maybe because of the Iran war, but also because of some other aspects around the world. So I think the inflation seems to be the most important issue for the new leadership of the Bank of Korea, and the Governor Shin wants to convey the idea that current MPB is totally different from the previous one in terms of raising the rate. So he wants to convey to people that people has to expect that sooner or later Bank of Korea will raise the rate.
Signs of a future rate hikes in the future. But like we've been saying, the BOK held rates this time, but today's statement and press conference sounded much more hawkish. What about you, Professor Kim? What stood out to you the most?
Yeah, as Professor Shin, well explained, the Bank of Korea's decision to hold the base rate at 2.5 probably served as a staging ground for a definitive tightening cycle, driven by a massive export boom and compounding geopolitical supply shock. The central bank has completely erased the previous easing biases. I believe that two highly hawkish anchors from Governor Shin Hyun-song's debut press conference and the official monetary policy statement stand out. First and most importantly, the Bank of Korea governor announced a full, rapid, clear path forward. It means, central bank governors usually avoid giving explicit one-sided, commitment. However, Governor Shin took the rare step of declaring that the macroeconomic trajectory is entirely aligned toward the higher rate. He noted that, while central bank, typically struggle when chasing multiple objectives simultaneously, today's situation is an exception. He said that, right? Whether looking at inflation, GDP growth, or foreign exchange rate, or real estate, every single metric point clearly toward the necessity of the rate hike. the BOK explicitly modified its statement to note it will now decide timing of any rate hike, completely deleting past remnant of rate cut optionality. Secondly, I think this is one of the most important part is it showed zero tolerance for a weakening won. The Korean won's breach of the psychologically critical 1,500 per dollar level has turned the foreign exchange market into primary driver of monetary tightening. Governor Shin used remarkably blunt language to target currency speculators, stating, will not tolerate one-sided move in the currency market. Now, because a weaker won immediately translated into expensive import bills for local factories and consumers. The BOK is treating the defense of the won as an extension of its inflation fight.
Right, definitely. So a lot of factors playing in this latest direction. So what about Professor Shin? Then what do you think has changed the most in recent weeks to shift markets into this hawkish direction?
Well, first thing that I want to mention is that two members of MPB, both of whom has been pretty strong dovists for their entire tenure, which is the governor, previous governor and also one of the MPB member, Mr. Shin. He's also last name Shin, and those two dovists has left MPB. That's one thing, and also the rest of the five members has been pretty. Realistic in the sense that they have to understand the current surging inflation. In that sense, I think they are rather hawkish, and that two member of MPB has expressed their opinion that today's meeting, they have to raise the rate at least 25 basis points. So the reason that there has been change in general mood in MPB is two dovists has left, and also the surging inflation, and on top of it, exchange rate has been so volatile, for the last I think couple of months. So now I think more important, for the Bank of Korea is not inflation, but rather I think it is exchange rate market. So in order to calm down exchange rate market, I think the Bank of Korea has been feeling that the rate has been too low at 2.5% against the 3.75% of the United States for such a long time, and it has come to act on the part of the Bank of Korea to correct the interest rate imbalance. So I think is the main reason that current new leadership under Shin Hyun-song is trying to stabilize exchange rate market rather than inflation, because in my opinion, inflation is going to come down very quickly, if the Iran war comes to an end.
So exchange rate is also playing a very big factor right here. Now, the BOK actually today sharply raised its outlook for both growth and inflation, forecasting 2.6 growth and 2.7% inflation this year. Professor Kim, what do those kinds of revised forecasts tell us about what the BOK sees about the Korean economy?
Before I mentioned, these things, from according to Professor Shin, it sounds like a regime change in the central bank. Yeah, probably that's right. But I think, this is a very important part that they, revised in two figures, right? That signal that central bank now views to South Korea as a hot supply shocked economy operating well above the sustainable potential. By pushing both metrics significantly higher, the BOK has officially declared the macroeconomic landscape is, transitionally overheating, completely shutting the door on the post-pandemic stagnation narrative. The numbers reveal, probably three specific shifts in the BOK's macroeconomic overviews. Firstly, the massive leap in the GDP projection from 2.0 to 2.6 means that BOK does not view the first quarter boom as a temporary blip. Rather, it recognizes that the export engine is strong enough to counter weak domestic consumption because it is driven by, insatiable global artificial intelligence and semiconductor upcycle. The BOK revised, its next year GDP forecast up to 2.1%. By modeling two consecutive years of growth above Korea's long-term potential rate, which is 2.0, Governor Shin explicitly warned that demand is outstripping supply capacity, generating organic domestic hit. Secondly, it views the inflation is sticky, domestically contagious, and uncomfortable. The upward revision of the inflation to 2.7% from 2.2%, right, indicate that the price pressures are no longer just as an imported energy problem. Governor Shin specifically highlighted that living cost inflation hit 2.9%. The BOK also fears that prolonged high oil prices from Middle East friction and weak won are morphing into secondary effect. Consumers and businesses are starting to expect higher inflation, which can trigger a dangerous wage price spiral. Thirdly, I believe that today the BOK announced a formal exit from the low growth, low inflation era. For years, policymakers worried about the South Korea falling into a Japanese-style deflationary trap of structural low growth. This joint revision to a high growth and high inflation mix tells us that BOK sees fundamental shift in the macro environment. The central bank is pivoting its long-term strategy away from economic management and entirely toward aggressive asset price and currency defense.
Then, Professor Kim, like we've touched upon a while ago about this exchange rate, the won remains above 1,500 per dollar, while the U.S.-Korea rate gap is still quite wide. How much are this exchange rate concerns influencing the BOK, do you think?
Well, I believe the exchange rate concerns have shifted from being a background risk so far to primary and active driver of Bank of Korea's policy calculations. The currency slide past the psychological critical 1,500 won per dollar mark has essentially forced the BOK to directly accelerate their transition toward an aggressive interest rate hike cycle. Most important issue regard to the exchange rate is that the transformed foreign exchange inflation transmission loop, which is a kind of difficult term, but in the past, a weaker one has tolerated because it boosted the price competitiveness of Korean exporters. Today, that calculus is entirely inverted. Because South Korea imports nearly all of its energy and industrial raw materials, an exchange rate hovering over 1,500 won act as an immediate toxic tax on domestic inflation. The BOK decision to sharply lift its inflation outlook to 2.7% was heavily weighted by the reality that a weak currency is making imported oil and food permanently expensive. Second issue is preemptive shield against a new worse Fed. I mean, the Kevin Walsh, became the U.S. Federal Reserve chair of this Federal Reserve, right? And he would battle sticky U.S. price pressures. Expectations for American rate cut in 2026 have completely evaporated. Rather, we see the U.S. rate hike starting to emerge. The BOK recognized that if the Fed hike, while Korea remains frozen at 2.5%, the interest rate gap would fracture even further. The BOK's sudden hawkish pivot, serves as a preemptive defense mechanism to absorb the shock of an aggressively tight U.S. dollar environment.
Right. Now, shifting gears a little bit, another major takeaway today was the updated dot plot, Professor Kim, with most board members projecting higher rates within the next 6 months. How strongly will markets take that as a signal that the BOK is entering a tightening cycle?
Well, after looking at the highly aggressive dot plot, I think, oh, the unanimous whole year is over. The BOK revealed a deep structural split, within the Monetary Policy Board, as Professor Shin mentioned, right? Two board members, broke in rank to vote for an immediate 25 basis point hike to 2.75%. In terms of the 6 months outlook, the newly released forward guidance dot plot showed that 10 out of 21 projections over the next 6 months forecast a policy rate of at least 3%. 7 dots is at 2.75%, while two aggressively projected a climb to 3.25%. I presume that the market will interpret the dot plot as a strong signal that the BOK has effectively entered a tightening cycle.
Now, Governor Shin has long stressed the importance of acting before inflation becomes more deeply entrenched. Professor Shin, could that philosophy make the BOK more proactive under his leadership?
Well, we have to see, we know not much about the new leadership of the Bank of Korea. Well, there has been a lot of rumors and reports on the media, but we have to see how his steps will be in the future. But that is very clear. Thing is that out of 7 members, 2 Davos have left MPB, and all the 5 members, the rest members seems to be pretty hawkish in traditional terms, and also environment in exchange rate, environment inflation. And environment, economic growth, everything, shows that it is the time for the Bank of Korea to raise, it should not hesitate not to raise. So I think the mood has completely changed, and the environment has completely changed for a rate hike. I don't know how many times, but at least 2 times this year, and possibly 2 more next year. So we have to see how strong, the new leadership is going to be in directing the Bank of Korea without intervention from the political side. I think that is the most important issue that we have to look for the rest of the year.
Now, shifting gears, Professor Shin, before we conclude, Korea's stock market, it continues hitting record highs on strong AI and semiconductor momentum. SK Hynix now joining Samsung Electronics in the trillion-dollar club. Korea has become the only country besides the U.S. with at least 2 companies at that level. What does that say about Korea's economy right now?
Well, I think a little misplaced. Stock market is misplaced in the sense that it is a little bit overblown. So, it has been 2,500 last year, and it is over 85 something. It is it is almost like a miracle, but it is hard to understand it. It is hard to explain. So I think current level is too, overstretched. In that sense, I think it's going to be a correction for the rest of the year. And I think very scary stock market in Korea. So we should not pay much attention, in the Kospi being over 8,500. I'm nervous. I'm very nervous about Korean stock market.
Then what does that strong momentum, do you think it would affect the BOK's, direction moving forward?
Yeah, he mentioned, new leadership has mentioned about, the inflation aspect of a very strong stock market. But even without that, I think, the rate of increase in the stock prices are too scary. And I think there should be a significant correction down the road in the second half of the year. So we have to be very watchful about serious correction in the market.
All right, thank you for that opinion. Now, so while these markets continue rallying on the semiconductor strength, there are also concerns that a rate hike cycle could pressure liquidity in equities as well. Professor Kim, what do you see as the biggest risk factor for Korea's markets in the second half of the year?
Yeah, I mean, before we discuss the risks, I like to extend the congratulations on the achievement of these two companies, to join the $2 trillion clubs. Anyway, the biggest risk factor, for South Korea's market in the second half will be the dangerous structural divergence between an AI-driven semiconductor export boom and a fracturing domestic economy choked by high debt cost, right? While the Kospi currently rallies on the back of global AI demand, the Bank of Korea, rate hike cycle to defend the currency will inadvertently trigger liquidity shocks across highly leveraged domestic sectors. The primary risk threatening to destabilize the market in the second half of the year will include, first, the fragile project financing debt, right? While tech exporters have a clean balance sheet, local construction companies and small and mid-sized developers are drowning in high-interest short-term debt. Secondly, the highest, household debt to GDP ratios in the developed world, which will squeeze household, consumption further and further. Thirdly, delinquency spike in non-banking financial institutions like a mutual savings bank and credit card firms and capital, companies have aggressively lent to higher risk borrowers and property values. They will face delinquency risk, when tightening start.
So from now, the key question would not only be whether rates will rise, but how quickly this tightening cycle actually moves on from right here.
Exactly.
All right. Thank you so much for your insights tonight, Professor Kim.
My pleasure. Thank you for having me.
And of course, Professor Shin as well. We really appreciate it.
Always my pleasure to be here.
And that'll be all from us on Within the Frame. Be sure to tune in again next time as we continue to explore the stories that matter. Till then, stay informed and engaged.